Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
And I'm Will.
So today it is just the two of us, the dynamic duo.
Just the two of us.
And today we're going to go over a couple of things. Did you just sing? Okay.
You and I. Brian.
Brian, where
MIA. We don't need it.
Brian's going to be in the comments.
That's it.
All right. So first up today, Memo, we have what Fed rate cuts in 2024 will mean for home buyers. The Fed holds rates steady, indicates three cuts coming in 2024. We have a VA IRRRL saving a homeowner more than $500 a month example. We have a case study we're going to go over today. And then we also have another article from Bloomberg about mortgage rates in the U.S. slide below 7% for the first time since August. Boo. So let's get into it today. Our first article is what Fed rate cuts in 2024 will mean for home buyers. We got some great news last week, which was that Jerome Powell and the Fed came out and said, hey, we are done with rate hikes, essentially signaling they're done, and they are going to have some cuts in 2024. What do you think of that?
Uncle Powell, finally
Pow.
good news in Christmas. Don't go spending all your money, though, ladies and gentlemen. Please don't.
Yeah, but, be cautious still.
Yeah, but this was just great. I mean, the rate wasn't increased, it wasn't decreased, but it still caused the market to perform better.
Yeah.
So it just gave some excitement, some optimism that we're heading in the right direction, right? But again, we still have the market indicators that we have to pay attention to.
Yeah, I think it's flashing some signs and projecting that they're projecting it's going to be better in 2024. Yeah. What's interesting to me is that the tone of the Fed changed in like 2 weeks. Like they said something completely different on December 1st, and then all of a sudden they come out on the 13th and they say something like it was almost like not the entirely opposite, but it makes me wonder what changed. What changed in those 2 weeks? Because for us, we saw the housing market cheered this results. Of course, you saw interest rate cuts coming on the horizon, and so even though the central bank did not completely rule out the possibility of a rate increase in 2024, the action seems unlikely. And now, fresh economic projections from the central bank officials showed that rates would be slashed to a median of 4.6% by the end of 2024. So we're at this 5.25 to 5.5 right now. We're looking at maybe a median of 4.6, which means we probably have 3 quarter point rate cuts coming in 2024.
That's crazy.
Now, the thing that's interesting to me about this is that, and on other shows we talked about this, like 24 is an election cycle. We are within the 1 year window of when we have our next major election. And so there's bound to be things that are going to have to just like hold steady, do not rock the boat. And other things where you're going to probably see some things change and shift and move to try to jockey and posture for some things as desired outcomes. I don't know. Do you think this is one of them, or do you think this is just a monetary policy only type of decision?
Here we go. We were talking about this earlier in the year. Election year is coming up. What president wants to have a market with high interest rates?
Yeah.
And so we always generally see that these things start dwindling down when it comes to a high interest rate environment. Things start dwindling down when elections come. Like we predicted this. Yeah. Because of, again, history always repeats itself. We've been seeing that in the past, that those are generally the indicators what happens. If there's a presidency, then you know what? The next president doesn't want to take all this bad publicity. They want to, So I feel like right now, going into this, does that have a huge effect? I think so.
I think it's a little bit of thumb on the scale. I don't know how much it is, but I will also say, like, this whole dot plot chart that they show that the Fed reveals in their notes and shows kind of where all the Fed members are voting or where they are posturing their pen, if you will, on the chart on the graph. And we knew that in 2024 they were telegraphing some sort of ease. We saw in 2025 and 26, and these charts go all the way back to the beginning of 2023, where I was saying that too. Because they're telegraphing it. They're showing you, hey, we have to do this. I think, honestly, one of the biggest markers in the end is probably going to be October of 2023.
Yeah.
When you look at October 2023, you had the 10-year yield flirting with 5%. You had mortgage rates touching 8%. Everyone, that was like the hand on the stove, and your body just goes, whoa.
Yeah.
We do not like that at all. I don't think the market's like that. I don't think the Fed like that. The government didn't like that. And anyone that didn't vocally say they didn't like it was privately disliking it a lot. I think that had a lot to do with this, in addition to the economic information shifting a little bit.
Yeah, no, it was brutal. October was brutal. I haven't seen anything like that. Yeah, I don't think anybody has ever seen anything like that.
Well, and I mean, look, for those of you new to the show, we're going on year 18. We started this in 2005. It's now 2023. Yeah. And, we had never seen the Fed cycle go this steep that quick in rate hikes. Yeah. And now we've never seen mortgage rates, in our career, now we see mortgage rates hit their highest in the entire time that we'd been in the industry.
Yeah, that's crazy.
At the same time that affordability has hit its lowest. I mean, so there's all these kind of markers that I don't think they want coming into an election cycle. And also, they're just really bad on paper. When you put the math on paper, these things don't add up to strong and strong economy for ages and ages. There's going to be some cracks,
crazy.
So.
I just like why. What was it? I read it here. While nobody in the mortgage would say this season to be jolly based on current market conditions, the Fed's outlook at its December's meeting points to an increased possibility of a happier new year.
Yep.
Said, is this another uncle?
Marty Green, Uncle Marty Green. Uncle Marty.
There you go.
That's a cool name.
Principal at mortgage law firm Polonsky Bitel Green.
That's right. Bitel Green. He's going to love you said that, Bitel. So all in all, I think the takeaway from here is that we're going to see lower mortgage rates in 2024. Yeah. Look, they're already kind of saying, hey, this is the inflection point where, rates have come down. They started to come down. We've seen rate decreases for several weeks in a row. On the mortgage side of things, you see the 10-year yield going, again, arm in arm. There they go, marching down the street together. The 10-year yield and mortgage rates follow the same course of action. And I think that expecting rate cuts is not only going to be healthy for the market, I think it's going to create some new problems we don't know yet. We can only forecast, like housing prices going up, demand coming back, people sitting on the fence, getting off the fence, coming back into the game. Well, now there's more buyers. Hopefully we'll see inventory pick up. I mean, some of those things we need to see happen, or for this to kind of get like unlocked and released. So,
I mean, again, we go back to the simplicity of things, right? When interest rates rise, usually we see a lot more homes available. This was not the case.
Yeah.
Again, just because of our shortage, it's simple economics, supply and demand. So if rates go down and there's just more demand, prices of homes are just going to continue to go up.
And what's apparent to me is that with this decision, the Fed has determined that they have done enough. That this whole monetary policy of getting the Fed funds rate high enough, fast enough, holding it there long enough will eventually make its way and cycle through the producer price index and then the consumer price index, and then we start seeing it, going from the producer side of raw goods all the way into consumer sentiment and what people actually are spending in retail. Yeah. And retail spending is still actually really good. Now, of course, it's being broadly spent because of credit cards, but I think that is giving them hope that maybe a soft landing that I honestly was doubting super hard for a long time. This whole idea of soft landing, which, by the way, they haven't been saying that for months. But remember, they were floating this. Oh, yeah, soft landing's possible. It might happen, but here's the deal. It's going to happen in a very long time frame. It ain't going to be tomorrow. It's not going to be in 2024. It's going to take some time. Well, far from it. Inflation just isn't coming down fast enough for them to get to 2%. And I think they stated it's not going to get there till like 2026. So
is that what it is?
Yeah. Oh. So we'll eventually get inflation back down to a 2% target, but like in 2026. so okay. So here's the thing. Like back at the beginning of the year, that was kind of a spoken goal. Like, hey, we need to get 2% inflation, 2% inflation, 2% inflation. Well, that's fine. You'll eventually get there. It's just going to take a long time.
It's going to take a long time. And then we were talking about this, in last week's episode. The new norm is going to be that 3% inflation.
Yes. Yeah, absolutely.
Because it's just going to get a lot more difficult to get to that too.
Yeah, because even if consumers at large are spending on their credit cards in order to keep prices where they're at because they just have to buy stuff, well, that is going to have a perpetual nature to it where I'm spending because I have to buy the things I need to buy in order to live the life I'm living, and that then kind of fixes prices, which then of course is going to fix inflation. So
hey, but Andy, on a good note, the median sales price in the nation went up to $424,900 versus I believe last year it was at $417, $419, somewhere around there.
Yeah,
it's a 2.4% higher this year than last.
Yeah, and remember everyone that's been talking for the whole year like, oh, economic collapse, real estate collapse is coming. It's like, well, I don't know where, because if the median is 2.4% up from last year, that means that everything that's sold above and everything that's sold below, the median was 2.4% higher. That is also an indicator of what's to come in 2024. You're going to see stable house prices. And at large, again, you always make the point to people, your neighborhood's different, your community is different, your city is different. There's saturations in pockets where weather's a bigger issue, seasonal labor is a bigger issue. We're in San Diego, we have great weather all the time. So we don't have a lot of that here. But some other people do have to take that into consideration as they're listening to this, watching this, and making decisions for themselves.
Based on everything that you've seen, Andy, how do you feel? And I'm sure our audience would like to know, do you really feel that they're going to cut rates? The Fed will cut rates 3 times next year.
I think they're going to. So I did start to believe that they were going to cut rates when they started doing pauses in the fall of 2023. that they would eventually have to have an end to the pause and then a return to starting to cut rates. I honestly thought it was going to happen in Q3, and I'm on record saying this on a couple other shows and Monday Mortgage Minute. I think that they're going to start cutting rates in Q3 for two reasons. Number one, they will have had enough time to see things move through the economy in the 6-month lagging indicators, 9-month lagging indicators. By 2024 Q3, and also that's right before the election. So I thought there's a spoken, known, and an unspoken kind of pressure point that would make that happen. I'm already reading articles now where some analysts are calling for March, as early as March, having the first rate cut, and then another one I read said May. Those are still both in the first half of the year and not even in Q3. So that's going to be very interesting. But I did already say that. So kind of on the record, I'm already on the hook for whatever I had said before. It's there. It's on our channel.
Yeah. And, why do you think the Fed decided because I know there was a lot of talk in the beginning that when they met on the 12th, they said that we're going to increase the Fed funds rate.
Right.
They were talking about that. Why do you think, was it pressure from?
No, I think it's because gas is down. I think it's because oil's down.
Yeah.
I honestly think it is because, on the producer price index of things.
Yeah.
So those of you watching, producer price index precedes consumer prices. So whatever is increasing in cost on the producer side increases eventually in cost on the consumer side. Okay. So when fuel expenses go lower, and you've noticed we're not paying $7 gas for 91 octane, it's like $5.75 or it's even
$4.80 something at Costco.
Yeah, under $5.
Finally.
Well, there was a point where I'm over there paying $7.65 for 91 octane.
Brutal.
Okay, I'm not paying that no more. It's back down to $4.89 or whatever.
Go to Costco.
Yeah, but even at the nicer places, the Chevrons and the Shells, it's what, $5.50? Okay. But my point is that on the producer side, when you're a manufacturer and you're making goods and services and you're trucking things, that gets baked into the cost that makes it to consumers. So I think short answer is they saw PPI ease, and the PPI easing means that in the upcoming months and quarters, it will be easier on the consumer as well.
Gotcha.
And I think that's what made their decision to pause and also telegraph that they're going to have some rate cuts in the new year.
Okay, I like that. I like the simplicity of that.
And then
Thank you for keeping it simple.
And then I think it's just aided that, okay, we know we got an election, and I think there's some of that silent pressure that may not be so silent behind closed doors.
Silent night.
Yeah, no silent nights at the Fed. All right. Next article today is Fed holds rates steady and indicates 3 cuts coming in 2024. With the inflation rate easing and the economy holding in, policymakers on the Federal Open Market Committee voted unanimously to keep the benchmark overnight borrowing rate in a targeted range between 5.25% and 5.5%. Committee members penciled in at least 3 rate cuts in 2024, and that's less than what the market had been pricing in, but more aggressive than what they had previously indicated. That's great news, number one. Number two, honestly, if I'm being completely candid,
please.
And I did not tell you I was going to do this, I honestly am concerned about them cutting rates that soon. And here's why. We started this little process in March of 2022.
Yeah.
So here we are in December of 2023, 21 months later.
Yeah.
Now, we've had a couple of pauses, and then we're looking at maybe a cut in March or a cut in May. There's a lot of data that has to soften in order for that to happen over the next 90 days.
Yeah.
Or 120, 150 days, which sounds like a lot, but it really isn't a lot, you guys.
Yeah.
Look how fast Christmas came upon us. Look how fast the fall was gone. Look how fast we're already in 2024. So I think it's nice that these Fed members are saying this, but again, because they're making data-driven decisions, I am hesitant to get 100% on the bandwagon on that.
I think so too. I think there's a lot of pressure everywhere, and the Uncle Powell seeing that. There's a lot of pressure. The only thing with Uncle Powell, he's got a big ego. He doesn't just get influenced that easy, You
think so?
I mean, we've seen it, right?
Yeah.
Like he just kept hiking, and look.
Yeah.
Now I think, okay, all that pressure is just putting him in a position where I think we're going to start kind of easing into doing those rate cuts. But, early on, maybe a couple of weeks ago, we're hearing 5 rate hikes. I mean, 5 rate cuts.
Yeah.
So,
there was that analyst that called for
now
5 rate cuts. I'm like, man, that seems really steep. Even if they're 5 quarter points, that takes you all the way back down to 4 on the Fed funds rate, or it would take you back to 4. That's pretty aggressive. But and my initial thought to that was, well, something would really be going wrong if they have to do that quickly, because that's also 5 out of what do they have, 8 meetings throughout the year or something like that. So out of the 8 meetings you're going to have, 5 of those are going to cut. That might be a little too aggressive right away. But this is really a story of inflation. Whether they intended it to work this way or not, I think they're getting some help from inflation.
I agree.
They did add this qualifier that inflation eased over the past year while maintaining its description of prices as elevated, and that they see core inflation falling to 3.2% in 2023, 2.4% in 24, then to 2.2% in 2025, and finally getting back to this 2% target in 2026.
Jeez.
Hashtag quick reminder for all of you, it says the word falling, but this is still an accelerant measurement. There's still a positive plus sign in front of each of these numbers. So that means that inflation will still be going up by 2.4% in 24, up by 2.2% in 25, and then still positive 2% in 2026. So slowing does not mean reversing. Have to clarify that. Had to answer those questions in the comment box as well, which is fine. But just be cautious when you're looking at videos like this and you're watching graphs and you're looking at charts. If it's in positive territory, it's cumulatively positive. Yeah. It'd be like my weight going up 2% per year. Like it's still going up. Hey, until that weight goes down 10%, that 2% up is just up and up and up and up.
Oh, no. We don't need that, Andy.
Yeah, we don't need that.
I know the holidays are here, but let's not have an excuse of why to gain 2%.
Yeah, coming into the end of the year, we've had a lot of shows this year. We know this has been our first full season kind of in this format. Yeah. We have talked about the Fed a lot more than I wanted to, but it is kind of what comes with the job. This is what we have to do to inform people and then translate that and what that means for people in homeownership
and that's what's happening. Everybody, the Fed is, they're influencing everything we buy, anything we do. I think it's good information for the people to know. Yeah, it's good for us to also know. Well, because in that way, we're just figuring out a way how to encourage people with data.
Well, and think about the people that they might have gotten ridiculed or criticized for pulling out that HELOC in 2023. Well, if that HELOC is on a variable, which it is, and it's going to be Fed funds rate plus prime or whatever it is, and on that, it's going to be going down. So your monthly cost is going to be going down as your balance is going down, and your debt service every single month will be less expensive as long as you're not charging up that line of credit. But this is a force function of looking at 3 rate cuts in 2024, is you're going to see that those payments are going to be lower in order to debt service, not higher. So I think that's a positive coming out of this as well.
Yeah, and being that, consumer debt is at its highest ever in history, ever recorded in history, I think it's going to be a huge benefit, win-win in many, many ways.
Yeah. Yeah, so. And I know we saw last week we talked about the CoreLogic home price index report, and that had house prices up for 2023. It's a Q3 reading, so it is a look back of Q3 of 2022 versus Q3 of 2023, and home prices were up, and they had accumulated another $1.1 trillion of home equity in that same time, which is about the same amount of consumer debt we have. So, hey everybody,
hello,
hey, you can redeem that $1 trillion equity and pay off all this consumer debt,
please.
That consumer debt is not spread across only homeowners. So qualifier for those of you who want to comment, we know that's not all homeowners that carry debt. Okay, we need to move into this awesome case study because I did not know that we were going to have this conversation this year.
Soon.
I thought we would be having this conversation summer of 24, maybe in the fall of 2024, but here we are today talking about the VA IRRRL, which is short for interest rate reduction refinance loan.
Correct.
So the VA IRRRL, tell us about it really quick for anyone who's first-time watcher or has not heard about the VA IRRRL. Tell us what it is, and then tell us about this case study.
Yeah, it's just simply, veterans, since they serve our country, they have this benefit of utilizing their VA home loan, and when they purchase a property, they put no money down, and they also have no mortgage insurance. And the interest rates is also in their favor because it's a government-backed security loan. And so when a person wants to reduce their interest rate, they utilize what's called the VA IRRRL, as you explained the acronym. And in this case, I'm same with you. It was just rates when the rates went down, and they went down as drastic as they did. We saw an opportunity that, hey, this client could save a lot of money right now. And who doesn't want to save money right now, right? If I can save anything, I'll save whatever I can. So in this particular case, we closed this transaction back in 2022 of November, okay? It was a $685,000 loan, and we locked it in at that point in time at 6.625.
Okay, all right.
And as we know, with active servicemen and women, they'll have, if they use their VA eligibility in the past, the VA funding fee is going to be different. In this case, he never used it, so his actual loan amount went up to $709,660.
So he financed the funding fee. Yeah.
Exactly, financed the funding fee. Well, Fast forward a year later, right? Here we are. Now we're doing a new loan amount at $715,580, which includes a VA funding fee of now 0.5%. That's part of, the VA. So that's not a charge a lender does. That's actually something the Department of Veteran Affairs has to charge to the consumer.
That's a good qualifier. That does go to the VA. That is for the VA benefit. So first-time use or subsequent use has a different fee. Correct. It can be lumped into the loan, and it does go to the VA.
Correct. In this case, $715 loan amount, $580. We locked them in at 5.875.
Wow, from 6 and 5/8?
6.625, correct. Wow. So I just couldn't believe that. Okay, rates went down. I didn't think I was going to see the 5s this year at all.
Well, okay, hold on. Here's what's crazy about this. I'm listening to you. I'm writing my notes over here. This means, okay, so they locked at 6.625 in November 2022. Rates went higher. So it actually went up above, and they crossed it back on the way down just like what, in the last month or
the last couple of weeks? Yeah, last couple of weeks.
Okay, so it was up at, because I know we were also this year in 2023 doing VA loans at 7%.
Of course.
7.25%.
October was again brutal.
October was brutal. Now, but hold on, because we're going to come back to this part. Because for those people, there's going to be a time frame where they're going to pass that threshold where now they can do the VA IRRRL.
Correct.
So I want to talk about that in a second. So for this case, though, they were at 6.625. Rates are doing whatever. Their rates are going to the moon. Then now they passed it back on the way down, and you locked them at 5.875.
Correct.
How much does that save them every single month?
That actually went from their current payment, which was $5,605. $5,605 versus their new payment, which is $5,057.
Oh, shoot.
Yeah. So that's a $548 monthly savings.
Whoa. $548. Okay, so then the question's going to come up, well, yeah, but they already paid, 12 payments. Okay.
Yeah, I mean, we already know the first 12 payments anyways. The first 12 years of, the life of a loan, the majority goes towards interest anyway. So it's like, what could they have paid there, right? So if you're really looking at 709 with the new loan amount of 715, that kind of tells you already.
$548 a month.
$548.
That's crazy, because that's not even a full percentage rate difference.
That's correct.
That's 3/4 of an interest rate difference, and so a 3/4% rate difference on this loan amount was $548 a month less.
Yeah. And what's cool about with VA too, there's a recoup period. You cannot refinance somebody if they're not going to recoup their savings within 36 months.
That's right.
That's right. There's that extra layer of protection for the veteran. Like if they're just going to save $100, it's not going to pass.
I'm glad you brought that up, because there's actually a couple of things. There's another one I just remembered, that their payment has to go, their monthly savings has to be 5% or more than their current payment, right? Yeah. So if you're saving less than 5% on the VA IRRRL, you can't even do it. It's not. You can't even come to our office and say, I want an IRRRL and save 4% a month. You can't. The VA will not actually endorse that.
So that's like a layer of protection right there for the consumer, and there's a sheet that you have to go by, which is awesome. So in this case, obviously $548, you'll recuperate because the expenses are not that bad.
Yeah.
And then we strategize it so they're able to keep, skip 2 months payments, because they were always paying in arrears, very different than renting. So we set up this whole strategy. So one of the things that we do is, in this case, we're showing our client how to put that money back into themselves and building that equity much faster. So we're telling them, since you've already been used to making this payment, right, of $5,600, we're going to pretend that your payment only changed by $48 a month. So what we do is we encourage them to apply $500 back towards their principal on a monthly basis. When you get your mortgage statement, you have principal, interest, escrow, insurance, and then it asks you on the bottom, would you like to add $500 more towards your principal? So you add the $500. If you do that and continue to do that every month, don't change your lifestyle. Just continue to apply that savings back towards your principal. I gave you the sheet right there, Andy. You can see if they put $500 towards their principal every month, that's an interest savings of $217,000
less
$632 that they would pay for the life of the loan.
Dang! Just by taking that same $500 and just reapplying it towards the balance.
That's it.
In addition to the payment.
Correct. And so if you notice there at the bottom, it says year until payoff. They paid off in 23 years.
Yeah, 7 years sooner.
Yeah, so you mentioned earlier they've already paid 12 months into it. Well, guess what? We're still, if we use the same formula, we still took additional more years off sooner going this route.
Yeah, that's crazy. Well, okay, so going back then full circle, not only is this person paying their house off in this method 7 years sooner, their monthly payment is less, any month that they maybe need an extra couple $100, they still have it.
They still have it.
They still have that
They're
savings.
not forced to do that.
But again, this is still at 6.625.
Yeah.
So if someone's at 6.75 or higher, or even at 6.5 right now, honestly, let me do the math real quick. Even at 6.5 or 6.25, this would still work.
Of course.
Basically, as long as your payment is going down by 5% or more, then you can do this.
Yeah.
And that you can recuperate your closing costs in the first 36 months after closing.
Correct.
Now, there's another rule on the timing of this, though. You have to have made 6 payments.
No,
it's
not
six payments.
You'd have to wait 210
days. Yeah, okay. So 210 days from your first payment.
Exactly.
Not your first payment date, everybody. Your first payment. So if you paid it on the 3rd of the month, then count 210 days, and then you're clear to do this.
Yeah.
So there's a couple of parameters. 210 days from your first payment.
That's correct.
It has to save you 5% or more. You have to recuperate your costs of refinance in the first 36 months. And this other stuff we're talking about with the home mortgage accelerator calculator is optional. But for people who are disciplined and in a good behavior spending-wise, this is crazy. Yeah. Saving over $200,000 of interest, that's a lot.
Yeah. And
that's
you know what's,
lot.
again, so instead of coming up with your payment at escrow, when you're closing escrow, if you save that money and your payment's $5,600, right? Because you're not going to pay property taxes.
Right.
Your insurance have already put into your closing costs. Well, that'll be like $10,000 there. So if your loan amount's actually the $715, right? You can just go and save that 2 months that you have right there and apply it back to your principal, and now you're at $705.
Dang, like right away.
Right away. If you wanted to do that, in this case, we didn't do that.
Right.
And then the other great thing about it, let's say, normally, because when you're active, only your base pay is taxable income. The BAH, BAS is not taxable.
Right.
So I looked at it and put there a 30% tax bracket. Okay. And look what the effective interest rate would be, just
4.1.
because that's right, because they're putting that $500 to go towards their principal.
Yeah. Well, and they're most likely, it's most likely even lower than that. I mean, 30% is pretty aggressive for someone who it's only their...
Again, I like to use worst case scenarios.
No. That's what I'm saying. Like, even being extra aggressive on the tax rate.
Yeah.
I mean, if tax bracket is lower than 30, this is even better for you.
Exactly.
But I think so here's the thing. That effective interest rate is never used by people who want to just make money off of you. And the reason is because that's not a rate you can lock, but you've effectively done that by adding this money every month.
Correct.
And paying off your loan early. The amount of total interest you paid over that duration would have meant that your effective rate was only 4.1%, even though your locked rate was 5.875, you said?
5.875.
Wow.
And what's cool about it, what people don't know also is, remember, your property taxes, your interest that you're paying is still a tax write-off. So this is not even aside from that.
Yeah. No, you're right.
It's just savings here, savings there. So it's like, once you understand the true formula, that's where it's got to make sense. And you got to educate the homeowner with this.
I'm all excited because for a lot of this year, we have not been talking about things like this. And so I know we were talking about these in 2020 and 2021 and a little bit in the first part of 2022. This is awesome to have this example back, this case study, talking about the VA IRRRL once again. Also, there is an FHA equivalent called the FHA Streamline Loan, and it has a couple of different parameters than the VA one does, but the same kind of rule applies. If you're going to be saving money every single month, the FHA has set it up so that when the interest rates come in your favor and they are dropping well below where you're at now, you can do what's called the Streamline Refinance and achieve some savings. And then if you want to, apply it to the mortgage accelerator calculator and still have the same outcome of paying off. And
the great benefit with these two programs is there's no appraisal required.
Yeah.
So
that's right. No appraisal. You just have to have made your payments on time, right?
That's it.
No late payments and no appraisal. That's right.
Yeah,
because it's not about the value of the home. It's about you're saving the money. So, duh.
This is for the betterment for the consumer.
Yeah.
Is what it is.
Yeah. That's awesome. So if you have questions about this, of course, you can DM us, make a comment. We'll write you back about your own personal VA IRRRL or your FHA Streamline if you need that. Thank you for bringing that example. That's a really strong one.
No, and again, for our audience out there, if you're doing a loan in another state or whatever, and you have your loan officer, look into the mortgage accelerator. Make sure, or if you need that, let us know. We'll be more than happy to run a scenario with you, and
that's good.
So.
That's real good. All right. Well, the last article of the day is mortgage rates in U.S. slide below 7% for the first time since August. This is coming in from Bloomberg. Freddie Mac economist says a market could thaw in the coming year. Buyers are still confronting a lack of home for sales. But look, man, mortgage rates falling below 7% is a big deal because it's been the first time in months. We had flirting with 8s in October. But for specifically VA, which is what we do the most of, it's well below 7. It's not even below. It's so far below 7, it's in the high 5s.
Yeah,
in some cases.
You know, depending on your credit scores, it's in the, high 5 or low 6s.
Yeah.
Which is great.
Yeah. And I think that, the article cites here that borrowing costs have eased for 7 straight weeks, bringing rates down from a high of 7.79% average in October. And the decline raises the prospects that buyers sidelined by high interest rates costs may return, because now we're looking at the average of 6.95%, which is 0.8% difference than where we were just 2 months ago. That is a very, very rapid change. But we've also seen the equivalent amount of change in the 10-year yield, going from 5% down to 4% again. Yeah.
As a matter of fact, I have another client that, we qualify them at $775,000. Okay. And it was at 7.375. And they're putting 20% down, 790 mid credit score is what they had. So I repriced that, and now they're all the way down to 6.375, a whole 4% lower. And that automatically got them to qualify to $860,000.
Whoa.
So $85,000 more, 75, 50.
Yeah, $85,000 more.
$85,000 more. And the payment was still, I want to say like $4 difference lower.
Dang. Okay, let's go back over the math really quick. So they originally qualified for $775,000 at a rate of 7.375.
Correct.
Now the rates have gotten better. They are now at 6.375.
Yep.
And because of that, the cost equivalent of their monthly payment allows them to afford $85,000 more, which means now they can afford $860,000.
Correct.
Now, really quick pause. All of you who are talking about home prices falling and collapsing, this is why they cannot and will not, is because you have willing buyers who are going to go and tackle a home at $775,000 with a 7.375, and now will upbid their offer against other people because the rates have gone in their favor. This is also the thing that we were kind of forecasting and warning people. If the Fed starts cutting rates, whether it's now, if it's multiple times in 24, 25, this will continue happening. This is exactly the scenario that, when broadened and done by more and more volumes of people, is going to put price pressure on homes. And we're already seeing that reflected in the new conforming loan limits. Fannie Mae and Freddie Mac are basically admitting, everybody, that a 5.5% home price increase in the new year is either their catch-up provision or what they're forecasting we're looking at. This, thank you for letting me give time here. Thank you for giving me the time to do this. This is why we've been saying this. This is going to happen because there's already pent-up demand. There's lack of supply. And when rates go down like this, people can afford more.
Well, this just gives more encouragement. It just encourages people more, like, okay, we're going in the direction, might as well just get it done. Yeah. And now I could afford more home because it puts you in a different pool.
Well, and you can outbid people. Yeah. Okay, so this same scenario, let's say someone, because again, this is just the example you're giving me right now.
Damn, you're excited, huh, Andy?
I am, because here's why. There are some people that were sidelined last year. They were sidelined because they're like, oh, either emotionally or psychologically, I don't want to jump in the housing game. Or mathematically, they were eliminated. So if this brings affordability, because these people didn't have to go to 860. Yeah. They could have saved their 775 purchase price or loan amount and gone down to 6.375 and saved, I don't know, $800 a month or $700, something ridiculous like that. So this opens up affordability for people who thought they were out. Increases purchase price opportunity for people who are 100% in and committed no matter what the rate is. And it confirms and validates what we've been talking about. When rates go down, people are going to show up again. Yeah. They're already doing it.
So this is great news for a lot of people.
You think this is going to bring inventory? Because if high rates
this is not going to bring.
Inventory,
yeah, exactly. Usually it's the other way around.
Well, that's what I'm saying.
And here's the thing. I don't think we're going to see inventory anytime soon. It's going to take a long time.
Okay, just to hear me out. What about the golden handcuffs argument, though? Because we've been talking about so many people that have like 2.5%, 3%, 4%. Now that like gap between 8 and 4 is like got down to the 6s. Do you think that will now encourage some people to list?
Absolutely. I think once the rates start going down, it's going to give that encouragement.
So Lawrence Young, the chief economist from NAR, is saying we're going to see 6 to 7% interest rates all in 2024. It could be maybe just in the 5.5 to 6.5, honestly, because we're seeing VA below 6%. But I think that because we've had the reverse experience where when rates do go up, we see inventory show up.
Yeah.
Well, it didn't happen. So maybe we will see the opposite in the same way. Well, when rates go down, inventory shows up. Because I think some of those handcuffs are going to break off for people.
And I actually say with the 3 rate cuts, if that does happen, I'm really thinking with the rates, they're going to be in the high 4s, low 5s.
Oh, wow.
That's what I'm thinking. If that's in general, if that does happen, the Fed does reduce the rates by 1.5%. I think that's what we'll start seeing.
Well, and I want to, and I have not said this on this show, but I think that one of the things that I know in my private surveying and researching for these kinds of talks, I know that the Fed needed to get their Fed funds rate higher than inflation and hold it there. So now that inflation is ducked below it and is held below it and is easing its way down, they're going to have room to notch themselves down too. And as long as they can keep that Fed funds rate higher than inflation, then we're likely to see lower mortgage rates as well. The 10-year yield will follow that lead, and so will the mortgage-backed security market.
Just need more homes.
We just need more homes.
Let's go. More homes.
Back to you, home builders. We need more homes still.
Come on, home builders. Yeah. Let's get this.
But again, it's okay. Quick thing is on home builders, this should also give them encouragement that if home prices are going to stay and people can afford more and rates are going down and people are thawing out and coming back to the market or re-entering the market to afford, guess what they should be doing? They should be building more homes. I would think. But, I'm not a home builder. I'm just this guy talking on the show. I hope someone writes something about that in the comments. Yeah, you are just a bald guy on the show. Papa Palone. Papa Palone. All right. Well, Memo, thank you so much for joining me here to talk about all this stuff today. Really excited. Lots of really cool things happening. Finally, to have a whole year of just chaos and uncertainty and weird stuff talking about monetary policy and the Fed and all this like tech talk stuff. Really excited to talk about some of these things today. What was your favorite part of the show today?
My favorite part of the show is once again knowing that we can save people money, and we just got to continue to pay attention to people's situations. And then if we help them understand how to build, good savings, like let's just continue to pay more attention to these things right now in our clients.
Yeah. What's crazy to me is, several shows ago, you had an example of someone saving like $1,300 a month. Brian had an example of someone saving $1,200 a month. You give an example today of someone saving $548 a month. Even if someone's saving $300 a month, like that matters.
Yeah.
You cumulatively add that up. That's $3,600 a year. And in 5 years, that's $18,000. So, that really matters to people. And I'm really excited to hear more discussion. And I'm getting some interest in the comment box about the Mortgage Accelerator Calculator.
Yeah.
Look, as a mortgage company, our job is to sell you a loan. We don't have to show you how to pay off your house, but we love doing it. We love helping you save money and actually show you how to pay off your house so you don't need a loan.
And it's compounding. One thing that Albert Einstein came up with is compounding interest, right? One of the best freaking things he could have ever invented there or made us aware of. Yeah. Okay. And so the thing is, now that has a reverse compounding effect. When you're paying $500, remember, you're paying down as every month that you're paying down principal, interest starts reducing.
Yep, that's right.
So it has the reverse effect.
Accrued interest.
All you're doing, we're teaching people how to utilize a compounding effect in a reverse way to benefit them and build equity.
And I don't mind being contrarian. I don't. I know it probably sounds counterintuitive. We're like, oh yeah, well you guys sell loans, you make money by doing loans. Yeah, we do. But at the same time, if we can help people win, and that means for them paying off their house, whatever, like that's a great celebration too.
Yeah.
Doesn't always.
I mean, I do that. I pay $500 every month towards the principal.
Yeah.
I shared last week that Tanya was all excited. Look how much we owe.
I know.
Practically nothing, which is great.
I know. That's crazy.
So
it's crazy. And you bought that house at the bottom. Oh my God. Well, thank you for another great show. Thank you for everyone watching the Mortgage Heroes Weekly podcast. If you are watching on YouTube, remember to like the video, subscribe to the channel, and turn on notifications so you catch every episode. For those of you who are listening on your favorite podcast platform, whether that is Apple or Google, remember to turn on direct downloads so that every time we post a new show, you hear it first. Thanks for watching, and we will see you again next week.
Yep. See ya.